Welcome to BullPips, where we make your knowledge for trading simple, clear, and profitable. I am your step-by-step guide, and together we will master the markets. Whether you are just starting out or growing your portfolio, with the right knowledge and strategy, your journey to success starts right here. Let us begin.
Open a trading terminal for the first time, and you are immediately hit with a wall of blinking numbers, aggressive charts, and moving tickers. It looks like advanced calculus moving at light speed. A seasoned trader looks at that exact same screen and cuts through the noise. Ye sab insani momentum kayik sa kale hai. Every flickering number represents a buyer or seller making a move in a readable game of momentum. Think of a live cricket match. Forget the total score for a second and watch the energy on the field. The game is a constant tug of war between the batters, who act as our buyers, and the bowlers, who act as our sellers. Every time the batting team hits a boundary and scores runs, they gain upward momentum. The crowd gets loud, the energy surges. But the moment a bowler takes a wicket, the power instantly shifts back to the fielding side, killing that upward drive. Traders record this momentum using candlesticks, which track how price moves over a specific block of time. When buying pressure pushes the price higher, a green candle stretches up the vertical axis, creating a visual record of that upward surge. Those intimidating flashing numbers you saw earlier are just freezing these moments in time. Every single candlestick is a historical record of a continuous battle between buyers and sellers fighting for control of the market. To understand how you profit from these battles, we can leave the digital world for a minute and visit a traditional vegetable mandi. The rules of commerce here are exactly the same. If a trader buys a crate of tomatoes early in the morning for 500 rupees, they are doing so with a strict plan. They intend to hold on to that inventory until the evening market gets busy, hoping the price rises to 700 rupees. In trading terms, this is called going long. The trader captures the 200 rupee difference between their morning purchase and their evening sale. Profit is simply buying an asset at a low price and selling it at a higher one. You apply that exact same logic when you sit back down in front of a glowing Forex terminal. Except instead of trading tomatoes for rupees, you are trading one national currency for another. This diagram breaks down how a currency pair works, using the US dollar and the Japanese yen. The currency on the left, the dollar, is called your base currency. The one on the right, the yen, is your quote currency. They operate like two sides of a scale. If your research tells you the US dollar is about to strengthen against the yen, you execute a buy order. You are catching the momentum of the base currency getting heavier, driving the price upward. Zooming in on this chart, we can measure that upward climb. The smallest unit of price movement is called a pip. Before you start earning those pips, the price first has to clear a tiny gap called the spread, which is the broker's fee for executing your trade. By managing these small increments and choosing how much volume you want to trade, known as your lot size, you translate the classic Mondi principle of buying low and selling high into calculated digital profit. But what happens when the momentum flips? What if the Japanese yen fights back? The dollar weakens and the market crashes. Back in the Mondi, if you know a heat wave is coming and your tomatoes are going to rot and lose value by the evening, you wouldn't hold them. You would sell them right now while the price is high. And if you needed tomatoes later, you'd buy them back at the new, cheaper price. This red downward graph shows how that translates to your trading screen. By clicking sell or going short, you open a trade at a high price point. As the market falls, the distance between your high entry point and the current low price becomes your profit margin. Because Forex operates in pairs, the value of one currency is always relative to the other. You do not need the market to go up to make money. You only need to correctly predict the direction it is going to move. Operating in a dual-directional battlefield means you can profit from any movement, but it also means the market can aggressively move against you. Surviving requires strict protective barriers. This chart shows a defensive shield in action, called a stop loss. It is an automated line in the sand. If your prediction is wrong and the price strikes this barrier, the system cuts your trade immediately, capping your loss and protecting your account. On the offensive side, you have take profit. You set a target price in advance, and the moment the market hits it, the system cashes you out. It automatically secures your winnings and removes human greed from the equation entirely. The blinking red and green lights now form a readable map of buyers and sellers pushing against each other. Trading is the strategic management of that momentum. By understanding how to go long, how to go short, and where to place risk barriers, you begin to trade with a clear plan. Up to this point, we've studied how the markets move. Today, we put that theory into practice and actually place a live trade. To do this correctly, we will walk through a precise execution checklist, picking our currency pair, calculating our lot size, and setting up our defensive lines. This sequence uses a specific set of rules to map out a trade's boundaries before any capital is actually at risk. Before a professional ever clicks a button to enter the market, the true work is already finished in the preparation. Step 1 is opening your trading platform and selecting the exact currency pair you want to trade. For your first execution, focus on a chart you have already studied and understand, like the euro to US dollar. Look at this interface. Next to your pair is a numerical input field for lot size. Think of this as the exact weight of your trade. As you increase this lot size, you directly increase the dollar value of every pip the market moves. A heavier lot size means your position generates profits faster, but it also generates losses just as aggressively for every pip that moves against you. Dialing in this exact volume is your first line of defense against depleting your account balance. Once you know your weight, you build your perimeter. This chart shows a stop loss, a horizontal red barrier line placed at a specific price below your entry. Think of this like a cricket boundary rope. Once the ball crosses it, play is over. In the market, if the price drops and hits this red line, the platform automatically closes the trade, halting further losses. Setting this parameter is a required safety measure, ensuring you always have capital to trade tomorrow. Next, we establish the target. This golden line placed above your current price level is your take profit. A smart shopkeeper starts the day knowing exactly how much profit they need to make before closing the store and going home. Your take profit does exactly that. Reaching this mark automatically closes the trade and secures the money, protecting you from the temptation to hold out. With your volume set and your automated safety lines firmly in place, you are clear to execute the buy order. The execution takes a fraction of a second. It is merely the mechanical result of the meticulous risk and reward planning you just completed. But sometimes, immediately after entering, the market aggressively reverses. Watching a newly opened trade plunge into negative numbers triggers an intense physiological instinct to panic. Losses and sudden reversals are structural components of the Forex market. They happen to everyone, constantly. You anticipated this exact drop during preparation. That is precisely why you deployed the stop loss. A professional trader is defined by how they follow their risk management plan when their initial market analysis proves incorrect. The market crashes, but as the price hits your automated barrier, the trade closes safely. You take a calculated, manageable loss without facing total disaster. You selected your pair, sized your lot, set your shield, placed your target, and executed the order. You now have the exact workflow needed to start safely placing live trades on a demo account.